Welcome. I'm Jayden Doyé, CPA with Prestige Accounting and Consulting. Today we're talking about what happens when you inherit an IRA or a qualified retirement plan. Whether you're a spouse, a child, or another beneficiary, the rules can feel overwhelming. But don't worry, we're going to break this down clearly so you understand your rights, your responsibilities, and the tax rules that matter most. When someone passes away and you inherit an IRA, the IRS does not treat every beneficiary the same. The most important distinction is whether you are a spouse or a non-spouse. Spouses are given more flexibility, while non-spouses often face stricter deadlines. Depending on your situation, required minimum distributions may apply, along with what's known as the 10-year rule. If you are the surviving spouse, you have three primary options. You can treat the IRA as your own, you can roll it into your existing IRA, or you can keep it as an inherited account and follow beneficiary distribution rules. Each option affects when distributions begin, whether early withdrawal penalties apply, and how much tax you may owe. The right choice depends on your age, your income needs, and your current tax bracket. If you are not the spouse, such as a child, sibling, or other individual, the rules are more limited. You cannot treat the IRA as your own, and you cannot make new contributions. In most cases, the account must be fully distributed within 10 years. However, there are important exceptions. Certain beneficiaries, including minor children, disabled or chronically ill individuals, or someone within 10 years of the original owner's age, may qualify for extended payout options. Roth IRAs follow many of the same inheritance rules, including the 10-year rule. However, Roth accounts offer a major advantage. Distributions are often tax-free. If the Roth has been open for at least 5 years, beneficiaries can typically withdraw funds without paying income tax, even though the account still must be emptied within the required time frame. Some beneficiaries qualify for what's known as a Stretch IRA. This allows distributions to be spread over the beneficiary's life expectancy rather than being forced out quickly. Eligible beneficiaries include surviving spouses, chronically ill or disabled individuals, minor children until they reach adulthood, and individuals who are less than 10 years younger than the original account owner. For those who qualify, this approach can significantly reduce annual tax impact and preserve long-term value. Inheriting a 401k or pension comes with many of the same tax considerations as an IRA. Some plans provide survivor annuities, which may result in ongoing payments. Only a portion of those payments may be taxable, depending on how much the original employee contributed using after-tax dollars. Understanding this cost basis can help reduce your overall tax liability. Even in an inheritance situation, the IRS expects strict compliance with distribution rules. Penalties may apply if you take early distributions from a spouse-owned IRA, miss required distribution deadlines, or complete a rollover incorrectly. These mistakes can be costly, which is why timing, structure, and proper guidance are essential. Before taking action, start by identifying your beneficiary type. Then determine the most appropriate distribution strategy based on your financial situation. Finally, work with a qualified CPA or financial advisor who understands inherited retirement accounts. The right guidance can help you stay compliant, minimize taxes, and avoid unnecessary penalties.